Hello and welcome to Easynomics. I'm Siddharth Zarabi and you're watching Business Today television. JPMorgan will include Indian government bonds in its emerging markets index, and this will happen from June of next year. This is a major achievement, one that will have significant implications for the Indian economy and lead to a substantial increase in foreign exchange inflows. So what does this mean for the Indian macro story, for the rupee and for our markets? For more details on this, I'm joined by a stellar panel of guests. Jamal Mecklai, the Chief Executive Officer of Mecklai Financial and one of the most respected voices when it comes to currency. We'll also be joined by Nilesh Shah, the Managing Director of Kotak Mahindra AMC. Mr. Mecklai, welcome to the show. The first question, what does this really mean? How significant a move is this?
I think it's actually very significant because while there has been talk about it for a long time, so it was coming, it's not a surprise, but it's sort of in a sense a recognition, we are now a big boy. In many ways, we have been becoming a big boy literally over the last few years, largest population, third largest, fifth largest economy and the like. But this means the markets have accepted us, right? And more credit really to RBI and the regulators that have the investors recognize that we are a, quote, safe market, They wouldn't put the bond into the bond index if there was, it wouldn't have happened last year. There were lots of technical issues which were taken care of. But more than that, I think it's a very, very positive step for India.
We've been attracting lesser FDI inflows than in the past, $46 billion versus $59 billion in FY23. Is the bond just a side act, and is it actually meant for the currency, Mr. Mecklai?
Well, of course, dollars are dollars, right? Whether they come through exports or through equities or through debt. So that won't make a difference. The story is that once this is triggered, there will be about 30 billion that will come in. But one of the things that's very important to understand is, and so 30 billion is not that huge compared to the largest equity flows we have had, for instance. But it is, as I said, it is a significant investor. It is global institutional investors. And but the one thing that's very important is that, as I said, this is evidence of us becoming big boys. But big boys have to live in a big world. So, for instance, the volatility of our markets, which till now has been very contained, right, is likely to go up, not tomorrow, but as we become more of a global player, the volatility in our markets would begin to move towards the volatility in global markets, which is much, much higher than ours. So people will need to understand that and learn how to manage the risk better.
Managing risk better is obviously one of the most important things in the market. Nilesh Shah, Managing Director of Kotak Mahindra AMC, is also with us. Welcome, Nilesh. It's in some ways a day that was long expected, but tell our viewers, how significant is it, and what will its impact be according to you?
It's a step in the right direction. Today, India is the most open country on equity side. In India, the largest private sector bank, insurance company, mutual fund, the largest telecom company, automobile company, FMCG company is majority owned by foreigners. We are open than most Western world countries. However, our debt market had a very limited participation from global investors. When global investors bring capital, it augments our FX reserves, helps us tide over current account deficit and balance of payment, and also brings some amount of alternative flows, which domestic participants may or may not match. So it's a step in the right direction for India to become part of global ecosystem. With foreign participation, our debt market will become deeper. They'll have alternative source of funding. And obviously, there is no free lunch. With investors' participation, responsibility also comes in terms of maintaining their trust and confidence through better fiscal management and appropriate monetary policy.
Mr. Shah, we had a encounter with macro anxiety during 2020-22, high CAD, FII outflows. Do you think that this will help counter some of the fresh signs of macro anxiety that have emerged, especially on account of rising crude?
So, Siddharth, by now, we don't really worry too much about rising crude. In 2008, when crude touched 100, we were one third of Brazil and Russian GDP. Hence, the pressure was much, much higher. 2021-22, when crude touched 100, it pained us, but not like 2008, because now our economy is equal to Brazil and Russian GDP put together. As oil prices go higher, it undoubtedly creates pain for India in terms of higher payments. But our ability to bear higher oil prices is definitely there. And bond index inclusion or not, we have $600 billion reserves to pay for crude imports.
Yes, that's an important point, and viewers, experts have for a lot of time maintained that for a global macro trade, Indian bonds are basically a volatility trade also from a currency point of view. Mr. Mecklai, I want to bring you on the point of, the flip side of this, the overall amount and quantum that is supposed to come in. Do you think it will come in at the time that has been indicated, and what will it mean for our currency in the same time frame?
Well, I mean, the reports say to be about between $25 and $30 billion. I'm not sure it'll all come in day one, but once it's open, it will come in. It obviously will help the currency depending on its situation over there. In fact, there was an immediate reaction, as your graphic is showing, in the morning, but again, the rupee sort of slid back. One of the things is that, you were talking about oil in terms of why our equity investors are fleeing. That's not really the reason. The reason is because US interest rates have reached a level, and people after the Fed this week suddenly realized, I don't know why they suddenly realized it, that interest rates are going to stay up for quite a while. So it's down for investors. They can either put their money in the US with no risk or in emerging markets like ours. So that is really the driver for why the portfolio outflows have been increasing. And to my mind, that is not going to stop, because I don't think US rates are going to suddenly start coming down. However, clearly RBI, as Nilesh said, we've got lots of reserves, and RBI seems very clear that they do not want the rupee to collapse. There could be sort of a political face saving, but equally and more important, it's inflation. I mean, inflation is a real issue. It is also a political issue, but it is a real issue. So RBI would like to keep the rupee, prevent the rupee from falling sharply. And this 30 billion or whatever that comes into the debt market, even though it isn't coming today, it's sort of a nice insurance. Speculators will be loath to really push the rupee too low in view of this money that's coming in a few months or 6-8 months.
Yeah. Nilesh, there is commentary from different people, and some of them say that the number could be much larger. Do you think that is a possibility? Obviously, like Mr. Mecklai says, not on day one, but could it even be higher? Because I am reading some numbers which are saying it could even be in the range of 40 to 50 billion dollars.
So number one, Siddharth, as of today, we have an unutilized limit of foreign portfolio investment in debt market against 2,60,000 crore limit available. Total investment is roughly about 65,000 crore. Now, as Jamal mentioned, if you're going to get higher interest rates in US, obviously you will be expecting more return from emerging market like India. And today the gap is not that wide enough that it will attract global investors into Indian debt market. It's quite likely that in May 24, when we debut in index at 1% weight, there may not be much flows. But over a period of time, will global investors participate as enthusiastically in Indian bond market as they have participated in Indian equity market? Answer is undoubtedly yes. Today, you can't invest in Russia. With China, there is fear about Taiwan, there is fear about property bubble. Effectively, for global debt market investors, there are very few options left. India will provide a great opportunity because this is one country where debt and growth is growing in tandem. If you look at most of the Western world, they have to raise $2, $3, $4 of debt to create $1 of GDP. The debt is becoming upwards of 100, 120, 150, 175, 250% of GDP. They are all saying we'll keep interest rates higher for longer. Eventually, the debt burden is going to kill them, and hence they will need lower interest rates. In India, debt and GDP growth is in tandem. We borrow $1 to create $1 of GDP. Quite likely that our interest rates can remain little higher compared to Western world. And hence, from a carry point of view, people would love to come to India. It may not happen in May 24, but will it happen from 2024 onwards? The answer is undoubtedly yes.
On a lighter note, Mr. Shah, one of the questions that a colleague asked me in the newsroom was why June 2024? कुछ मई 2024 के इलेक्शन से उसका कुछ लिंक है क्या? I didn't have an answer for that. Would you want to offer one? Is there at all any link?
So Siddharth bhai, I had done one research long back and found out that if number of kangaroos which met with an accident on the left-hand side road of the Australia, in those years, Indian equity market does well. Now, that's a fantastic piece of research, but it's coincidence. There's no research behind it. There's no fundamental behind it. So there are few things which happen on coincidence basis. We don't have to read too much into it.
Absolutely. But Jamal, there is also more commentary that's been flowing in, including some view that India is also expected to enter other JP global bond indices, the JADE Global Diversified Index, for example, the JESB GBI-EM index, and other aggregate local currency indices. Do you share that view, Jamal Mecklai?
Well, clearly, everybody's been looking at India, and for some time there's been talk about JPMorgan and Morgan Stanley indices. There are many indices.
Yes.
As soon as one person jumps, everybody's going to get in line, in all likelihood. It's sort of like the rating agencies. One guy upgrades or downgrades, and everybody does the same. So I'm pretty sure others will come in. So there will be some more money, more than just the 30 billion people are talking about. But I think, as Nilesh pointed out, it really depends on what is the difference in interest rates between India and the US at that time. But the important thing is this is going to be ongoing. And as I said at the beginning, this is, I think, recognition that India is a bigger part of the global market than it used to. I think it's very loud.
Well, it's also the fact that, again, a sort of a layman's view that this has come soon after a very successful G20 summit that was held. And but just to add to this point that Jamal also mentioned, viewers, there's also commentary which says that India's chances of inclusion in the Bloomberg Global Aggregate Index have also risen with this development, and that and this is a point both our experts here have said, could result in further inflows of between 15 to 20 billion dollars. So, and possibly this could happen in one go. Nilesh, I want you to speak a bit more about the interest rate differential, again for a wider audience, given what is happening with inflation, given what the US Fed has said in its latest commentary. What kind of interest rate scenario should we be looking at till the June 2024 timeframe or around that, immediately after that?
As of today, if we go by what Fed chairman has mentioned, clearly they are not ruling out the possibility of not raising interest rates if data warrants in this year. This is a big departure from last year, where market was expecting rate cuts to begin in August 23. Now there's no rate cut on table definitely for whole of 23, but there is still possibility of a rate hike. And Fed has also indicated that yes, they will be looking to cut rates in 2024. But before the meeting, if there was expectation of 100 basis point reduction, post-meeting that has been brought down to 50 basis point. So clearly Fed is indicating rates to remain higher for longer in US so that inflation can move to 2% target range. If Fed is not going to cut interest rates, then RBI will prefer to wait and watch. We are in a very, very comfortable situation. Inflation had spiked because of tomato prices, but now tomato prices are back to 3-4 rupees a kg, and inflation will reflect that. Growth is still reasonable, and RBI has the luxury of waiting for global interest rates to move and then take a call what will be appropriate. So if I have to summarize this complex things, 2023, there might be a rate hike, low possibility, but still a possibility. And second half of 2024, we will see rate cut cycle across developed markets and emerging markets.
Okay, and when you say across emerging markets as well, just to be clear, you are including India in that as well, Nilesh Shah?
Yes, in my mind, I mean, I wish India was a developed market, but the reality is that it is an emerging market. We don't have a choice but to reflect that.
Jamal, Mecklai, one of the themes that we saw play out immediately after the announcement was Indian banks reacting positively, because the expectation is that their balance sheets will be freed up to some extent to allocate more funds to the private sector as well. I won't have asked you a bank specific question, but do you want to take a shot at it? Is that the right way to read it?
You mean why banks got excited?
Yes.
I think they got excited because everybody got excited, and they thought maybe they could make some money by buying rupees, which they did. The rupee opened at 82.80 and closed at 82.90, I think people are being a little bit coy, because there are lots of imponderables, obviously. But also normally what happens when an announcement like this comes, people in the market like to buy before and then sell on the event. But I think that, I'm not certain that the Fed has its finger fully on the pulse. I mean, it's conceivable that inflation may stay high for longer than they think. And so interest rates may stay high for longer than they think. In which case it's possible, and particularly if the rupee comes under pressure because of portfolio outflows, RBI may be compelled to raise rates sometime, So that could be another reason why people are not taking a punt on bonds right now. Because if interest rates go up, they would lose money.
Okay. How closely will investors look at the fiscal picture? Nilesh Shah, this is a question for you. I'm not only asking you about the central union number, but the overall states combined, and we are seeing a trend due to elections of fiscal slippages. It's clear between now and next year there will be at the state level especially. Is that a risk at all clouding the overall macro picture?
Undoubtedly, yes, Siddharth. If an investor is investing in India, of course, he's going to rely upon our track record since Harappa, Mohenjo-daro days till today, that we haven't delayed or defaulted to any global investor. But they are also going to look at the future. What is our debt to GDP ratio? How much fiscal deficit we are getting? How stable our monetary policies are? For debt investor, return of principal is more important than return on principal. And clearly, as a country, we'll have to assure investors that your monies are safe with us and you are going to get decent return on us. As a country, I will wish that we lower our risk premium. Today, our rating is somewhere little above junk level, but market prices us more like A plus, A minus country, several notches above what our rating agencies are indicating. This is reflection of India's fiscal and monetary prudence. We need to now take few notches that higher, that we eventually get AA plus, AA minus countries pricing, even the rating agencies may not recognize that.
Nilesh, since you make this very important point of improving the profile, I want to viewers quickly read out what the government has said. We haven't had them come on camera to talk about it, but the Secretary of the Department of Economic Affairs, Ajay Seth, saying it's a welcome development showing confidence in the Indian economy. The Chief Economic Advisor offering a much more detailed view. Quickly going to read that. Welcoming this development, the Chief Economic Advisor has said, JPMorgan has made this decision on their own. It attests to the confidence that financial market participants and financial markets in general have on India's potential and growth prospects and its macroeconomic and fiscal policies. Just as long-term equity investors have been amply rewarded by investing in Indian markets, so will long-term investors in Indian governments be. Jamal, Mecklai, the last statement, will long-term investors in Indian governments bonds be amply rewarded?
Nobody really knows, but my sense is I think so. I think one of the real important points, which we have not touched on, is that after decades where the inflation differential between India and the developed countries was vast, that has come down. So if the inflation differential has come down, then the, shall we say, expected rupee depreciation, which would eat up your returns from government bonds, will also come. I mean, there was a time when people just assumed the rupee was going to depreciate by 5% a year. I mean, that's meaningless, although it fell very sharply one year, but if you look over a long period, it's much less than that. And I think the key, is inflation control. I think RBI has done a great job and they continue to do a great job.
And that is perhaps one of the key items on the agenda. Nilesh, last question. You were talking about, lowering the risks. What do you think should be the steps from the RBI and also the government, perhaps, in terms of lowering the risk profile?
So I think in terms of fundamentals, we have done a great job. Between subprime crisis to COVID crisis, India is one of the few major economies in the world which has improved its debt to GDP ratio. We are one of the few countries in developed as well as emerging market where debt and GDP moves in tandem. And Reserve Bank of India, and Jamal bhai will agree, is like God's gift to India. They are an institution which has managed monetary policy, inflation target, currency, government's borrowing program with a fantastic way. Now, how do we convert this fundamental into a marketing campaign where rating agencies don't treat us worse than countries like Greece and Argentina which have far bigger track record of defaulting, yet enjoyed higher credit rating than us. Now, all of them are below us, but they have fallen. We haven't risen. So my feeling is that we need to communicate better with the investors. Today, lenders are pricing us as A plus, A minus country rather than triple B minus or triple B, which rating agencies have assigned. But we must communicate with rating agencies and other investors so that we get the rating which we deserve. I think fundamentally we have done good work, but marketing we can improve.
Fundamentally, we have done good work, and marketing we can improve. And as I wind down this show, just to add perhaps one more sentence, unless Jamal, you want to come in, I feel investors also need to ignore the noise. Look at the developments, a very successful G20, other fundamental reform measures as far as the legislative aspect is concerned, and within that endorsement for India's long-term economic potential. So if there's some noise, I think it would be good to ignore that. Jamal, final last word on the show to you.
Oh, dekho, this is India. We have really one, huge number of people, very, very huge amount at the low end of the pyramid. We are going to grow effectively forever. So people are going to want to invest. They want to have their, I think this is a very good sign that a lot of the nervousness about investing in India is disappearing. I think Nilesh's point about that rating agencies need to wake up, we've known that for a while, but it will happen. So I think we're on a good wicket, and good luck to all of us.
Absolutely. And while we bat on the wicket, the only thing we don't need to do is hit our own wickets. Nilesh Shah, Jamal Mecklai, thank you very much for your time with us today. With that, it's a wrap on this episode of Easynomics. We'll be back with more. Until then, goodbye.